A comprehensive retirement income strategy includes first getting organized, getting your Social Security projections together, accounting for your IRA accounts, putting together your 401k documents and asset values, as well as looking at your ESOP value. Peak Wealth Planning specializes in working with clients with $2 million to $100 million in investable assets. You can set up a discovery call with one of our team members. They'll collect some information. I'll personally review that information and schedule a call with you, and we can determine if we're a good fit to work together and help you meet the goals that are important to you and your family. In addition, you may have brokerage accounts, plus you want to look at what your spouse or partner has. So just getting organized and putting together all the different assets you have is the first step. The second step is laying out the income that each asset can generate and the timing of that income. When does that income start? When is it available to you and your family to pay expenses? Layer in on top of that the taxes that each one of those income streams may cause you to need to pay, both federal and state. So putting all that together into a forecast and optimizing how much income you can generate after tax is what a comprehensive retirement income strategy looks like. Keep in mind that some of these income producing assets, like an employee stock ownership plan, have restrictions on when you can access the funds. For example, you can't sell money back to an ESOP until age 55. Social Security, it's often optimal to take at age 67 or 70, even though it may be available at age 62. So working with a financial planner to optimize when you draw from these different sources can give you the most robust income possible in retirement without making decisions that might harm your overall income strategy. There are three types of accounts you can use to generate income during retirement. The first is taxable, the second is tax deferred, and the third is tax-free. Let's start with a taxable account. A taxable account might include an account that holds some stocks. Those stocks could have gone up in value, and when you sell the stock, you'll pay a capital gain, often at 15% or possibly at 20% federal tax rate. In addition, those stocks might generate dividend income. Maybe your stock that's $100,000 generates $4,000 a year of income, and you'll pay tax possibly at a 20% qualified dividend income tax rate in the US on that dividend. The second type of account is a tax-deferred account. Many folks have a 401k, or perhaps you're an employee stock ownership plan participant. Those accounts, when you draw out money to spend in retirement, you're going to pay regular federal income tax and state income tax. Oftentimes, but not always, those tax-deferred accounts will push you into the highest tax bracket that you're going to pay on taxes. So you want to try to minimize those withdrawals from those tax-deferred accounts by spreading withdrawals over many years. The third type of account is a tax-free account. That is a Roth IRA or a Roth 401k account. What's really nice about Roth accounts is there's generally no federal or state tax on withdrawals during retirement. However, there are some rules that you need to be aware of in that you have to have Roth accounts open for at least 5 years before you can take withdrawals and not pay taxes. So putting together these different tax buckets or these different tax accounts, this is a general guideline, not a hard and fast rule. For many folks, if they retire, say, at age 62, and they haven't started taking Social Security till 67, and required distributions from tax-deferred accounts don't kick in till age 73, it's usually tax optimal to spend from your taxable accounts first, while you're spending from those accounts to live maybe the first 3 or 4 years of retirement. You might do Roth conversions and convert some of your tax-deferred assets to Roth. So later in retirement, you'll have much, much lower tax burden. The goal is saving taxes across your lifetime, not always optimizing and reducing the taxes year to year. Many folks are not aware of this lifetime tax saving strategy. This can be a little complex, so it's really good to map this out with your financial planner and possibly run it by your CPA or your tax accountant to make sure that all three, yourself, your CPA, and your financial planner, are on board with this tax saving strategy. For individuals with a desire to retire early, there are two really interesting strategies you can use to minimize your taxes. Let's say you decide to retire at age 56. There's a rule called the rule of 55 that if you have a 401k from your most recent and current employer and you retire, you can take withdrawals from that 401k and pay regular in tax and avoid the 10% income tax penalty that you would normally get hit with by retiring and withdrawing before age 59 and a half. So as long as that 401k again is with your most recent employer, you can withdraw and spend if you've left that employer and retired. The rule of 72T can be an attractive solution for an individual who wants to retire prior to age 59 and a half and have steady retirement income while avoiding IRS penalties. I recently spoke with an individual that had $4 million in an IRA because their employee-owned company got bought out in one fell swoop, and he got a huge paycheck that wound up in his IRA account. He wanted to retire at age 55 from a very challenging job and downshift and become a wilderness guide. And we figured out in his situation that he could invoke the rule of 72T, which means he could withdraw substantially equal payments from his IRA that he has to start and take every year until he hits age 59 and a half. That way he can pay regular income tax on those withdrawals each year and avoid the 10% tax penalty. Keep in mind, if you invoke the rule of 72T, you have to continue it until age 59 and a half. You can't start it for a few years and then stop it. It's important to identify rising costs when you're creating a retirement income plan that could cause you to need more money to pay expenses later in life. The first is building in inflation. The cost of groceries goes up every year. The cost of your property taxes can go up each year. So we'll typically build in a 3% inflation factor for rising costs for everyday expenses. In addition, healthcare costs tend to accelerate at a little higher rate. So we might assign a 5% inflation factor to healthcare costs and maybe even health insurance premiums. Also related to healthcare, if you retire before Medicare age at 65 and your employer has been covering your health insurance, it's important to factor in perhaps $1,000 a month per adult in your household to cover out-of-pocket health insurance and out-of-pocket healthcare costs. Further, many of us are living a lot longer due to improved healthcare, especially in the United States. Longevity risks is real, meaning you might really get to enjoy yourself longer, but the cost of living a long time might mean you have a stay in an assisted living facility or you need help around the house when you're 85 or 90 years old. And it's important to identify those potential costs and build them into your financial plan. For some folks, they'll pay those costs out of their nest egg. For other folks, we'll identify risk transfer mechanisms where we can pay a lump sum of money to an insurance company for a long-term care policy and keep that nest egg so it passes to the next generation while having income to pay for help around the home or assisted living facility cost. It's often a good idea if Alzheimer's runs in your family to consider long-term care policy with lifetime benefits, meaning that pay for decades. Those policies are more expensive, but they can really help ensure that your loved one or yourself doesn't wind up in a Medicaid home. When individuals retire, it's important to set a steady withdrawal strategy for most families. They want to have fairly predictable retirement income, and perhaps they want to have a little bit more retirement income than might be as conservative. Let's talk about a bucket strategy first. We've all read stories in the Wall Street Journal about Jim and Sally were about to retire and they had millions of dollars saved and the stock market tanked due to some exogenous event and they had to delay retirement. A very straightforward way to avoid having to delay retirement or reduce your spending during retirement when there's a stock market correction is to use a bucket strategy. A bucket strategy in its simplest form is having a now bucket, a soon bucket, and a later bucket. The now bucket would have low risk cash in there, money market funds or CDs, used to pay expenses this year and perhaps the next 3 years. The soon bucket might include income generating assets that are relatively low risk, such as corporate bonds, treasury bonds, and maybe even some very low fluctuation in value dividend paying stocks. The later bucket can be much more aggressive. That might include international stocks, US stock funds, and maybe even some small cap, small company stocks. The later bucket's designed for growth to pay your expenses in year 7, 10, 15, and 30 of retirement. And the reason we want this aggressive stock-based long-term bucket is to overcome inflation and help you leave a legacy for the next generation. A retirement income withdrawal strategy is often based on what's known as the 4% rule. So a simple example is a family with $5 million can spend $200,000 a year when they retire from a diversified retirement portfolio. But let's say that family wants to spend 5% a year or $250,000 a year. A retirement guardrail strategy says, okay, you can spend $250,000 a year when you first retire, but if your portfolio falls significantly in value, maybe because you have a lot of stock exposure, let's say it falls from $5 million to $4 million, you might have to reduce your spending from 250,000 to 200,000 during those down stock market years. Conversely, if your $5 million portfolio races up to $6 million over a year and a half period, you might be able to spend a little bit more, perhaps $275,000 a year from your portfolio. So a spending guardrail strategy is a flexible retirement spending strategy, but keep in mind that's really appropriate for someone who has some fixed expenses that are well below their withdrawal strategy that they start with, so they don't wind up in a situation where they can't pay their necessities. The extra income when you're using a guardrail strategy should really be used for desires such as vacation travel or gifts to kids or gifts to charities, not covering your rent or your utilities or your health insurance. I would consider a spending guardrail strategy for someone who wants to take big trips or do big one-time events, and they're okay with maybe some timing differentials on that. And a bucket strategy would be more appropriate for someone who just wants predictable income at a steady pace and doesn't want to have to adjust their spending up or down. Retirement planning success is a result of pulling together all the disparate parts of your financial life and ensuring that you have forecasted the income you can generate with as much confidence as possible and accounting for factors such as unintended healthcare expenses later in life or increasing inflation. In addition to that, accounting for the taxes you're going to pay and trying to optimize or minimize those taxes across your retirement timeline is another piece of that plan. So when we bring this all together, an ESOP participant who has a lot of wealth there that's diversified into, say, an IRA, and we forecasted their income, who has a lot of confidence that they can meet their needs when they first retire and across retirement, is bringing all the pieces together. And it's our job as financial planners and wealth managers to bring that confidence to that family so they don't have to worry about it. In addition, the family wants to delegate investment management so someone else handles all this. Ideally, your financial planner or wealth manager is paying you a regular monthly paycheck after tax, and they're dealing with your CPA to make sure that your taxes are covered. The CPA has your 1099, and you don't have to worry about any of this. You just go and enjoy yourself with your second act hobby or supporting your community or spending time with your grandchildren.